Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, June 20th, 2025. S&P 500 currently sitting at 59.67. I'm David Zarling. I'm here with 2 weekends, Ian McMillan.
Feels like that. Yesterday threw me off.
Yeah, sometimes it does that. Market closed.
It truly feels like a Monday.
Yeah, no, it does. Yeah, it's kind of a weird dynamic when the market is closed. Yesterday being Juneteenth Day, I kind of wish they might call it Emancipation Day, like just call it what it is. But I'm sure there's some significance to.
Yeah, not the best holiday name we've ever come up with in this country.
Right, and
Labor Day, Memorial Day, Veterans Day, all pretty straightforward.
Yeah, and maybe it's a colloquialism, like a term that was used way back, Juneteenth, but from a broad marketing perspective, Emancipation Day would be a pretty cool term because it's important to celebrate, but I think it gets lost in the name a little bit. But I digress. It was nice to have a day off yesterday, closed markets. We're heading into where we get the longest daylight of the year, where it's summer solstice.
Yes.
Pretty
that
nice.
Happened starting today?
Yeah. Today and tomorrow we're in summer solstice time, and so these are the longest days right here, at least for us North Americans. So pretty nice. Not a lot to complain about, but it does seem like there's a lot to complain about in the media cycle.
Oh my gosh. A lot of hoopla we're exactly where we were last Friday when we recorded the podcast.
Well, and it's interesting, the algorithms on socials, the commentary in the family chats, a lot of focus on potential World War III. I find that very fascinating.
But isn't that such a loose term now?
Probably.
World War III, it's trending on Twitter every few weeks. Every little skirmish, is this going to be World War III? Yeah,
it does seem like the war drums are pounding from a news cycle, and I've got another term for news cycle that could be propaganda too. I think you just got to be careful not buying in and not, news has a job to do, and that's to sell you advertising, and you got to sensationalize what's out there.
But hey, we're above a. I want to put it back in the rising category. I think it's a rising 200 day. We took a little, little flat there for April, but we are back upward sloping. Maybe it is. I don't want it to be, but
yeah, I don't want it to be either. I'm not eyes wide shut on it. I'm not trying to be ignorant about it, but I also know that it's quite okay if cooler heads prevail and diplomacy takes place. But yeah, S&P 500 remains above a rising 200-day. The NASDAQ remains above a rising 200-day. The Dow Jones is just below its 200-day, and so is IWM.
Yeah, Dow Jones kind of bumbling around, and so Russell's been bumming it for a while, couch surfing.
Yep.
Who's ever willing to take him in for a few weeks?
Well, I think you talked about kind of being at the same place we were last week. International stocks, not so much. They got sold a little bit this last week. Wouldn't you know that that's happening at a relative rate of downtrend? You look at something like VEU versus S&P.
Yes. VEU, EFA in that same category.
Yep, exactly.
And it's always so hard because there was a lot of foreign hype there. Right. Like March, April. We own some select areas.
Right.
But this is why it's so hard. Foreign stocks is just very, very boy who cried wolf with me. And here we are again. So far, no wolf.
Yep. So far, no wolf. And there's different areas that showed strength this week. Energy makes sense when you consider last week and this week what oil has done. And I get it. You could say, well, Dave, yeah, that there's a conflict in the Middle East. There's bombing happening in Iran. There's the threat of closing the Strait of Hormuz. Like, well, yeah, but what's interesting is price in oil started accelerating higher before there were even any airstrikes on Iran. Again, the market pricing in before the news comes out.
We bottomed early May?
Right.
$55, and we're already back to 73 now. But we got up to 70. We got above 76.
And I think there's a couple different market dynamics worth highlighting in play. Whether it's something like semiconductors using SMH being against levels that we've sold at before, going back to June of 2024. Be interesting to see if we can shoot through the supply. The NASDAQ, same thing, at levels back in December of 24. Technology stocks.
Yeah, technology made it go for all-time highs, didn't it?
Right. So there's still some things to pay attention to here, not necessarily out of the woods, but the great thing about being a technician and using the study of supply and demand in your process is we've talked about 5,800. We've talked about the 200-day moving average. We've talked about the zero line or the January 1st date. We've talked about the election gap. These are logical areas where if this market is serious, if buyers are serious, they'll hold these levels. If not, then we know sellers have control and we can adjust accordingly.
Agreed.
What sectors, areas, you could take this anywhere that pique your interest when you look at what's going on, whether it's broadly speaking or underneath the hood in this market?
Yeah, you mentioned semiconductors. I think there's a lot of things that are pretty solid. Cybersecurity, like 6G, I believe came up in one of the workbooks. It's not a cybersecurity ETF, but like next gen connectivity, I think is palladium and platinum still. I mean, while gold is kind of chilled out, gold's been sideways for almost 2 months.
Pretty normal behavior.
It is. I mean, that's healthy. It's on a heck of a move.
When you look at like broker dealers and capital markets, how good they're looking on a relative basis. You've got JP Morgan on a relative basis trying to go out at new 35-year highs. And we're at the highest we've seen in that relationship since March of 1999. So think about that. You could have held S&P or JP Morgan, had the same return since 1999. So if we see JP Morgan break out of this base, or something like American Express versus S&P, which is on the verge of a 52-year breakout, and the highest level we've seen since February 2014. I mean, that's two pretty big financial indicators there. It's not that financials have to outperform, but if they're participating like this, really hard to get bearish on the market.
It is.
And if something like Apple, which has been sitting in the back pocket of this market, right? Apple's been underperforming for a while. If that starts to perform, and I know you highlighted on Twitter that we're back at levels that have shown to be support in the relative relationship since January 2023.
This has been a spot where, on a relative basis, investors, traders, whoever, have become interested. Demand for Apple could likely outpace demand for the S&P, or supply is less. I don't know which way. Maybe Apple underperforms to the downside. I have no idea.
Right.
But given where we are in the overall environment, we talked about the market is healthy. We haven't got to new all-time highs. It is healthy. Mags and FANGs have been good. XLK. So it wouldn't be a big shot. It's kind of the one. I mean, Microsoft is already to new all-time highs, has been there. Relative chart is, it's best since a year ago, July 2024.
Well, and if you look at something like communication services like XLC versus S&P, nice consolidation since February. So, we'll call it a 4-month consolidation, holding up very well. We would put that in the risk on bucket. But yet we have these levels, XLK at an important level, QQ at an important level, semiconductors at an important level, important in the sense of this is where they sold them before. This is where they started selling them in January and February earlier this year. Demand be able to push through supply here. It's interesting to think about, especially when you think about this period that we're heading into here. And I know seasonally speaking, Jeffrey Hirsch does a great job at Almanac Trader. He just highlighted that a mid-year rally, he calls it Christmas in July, that around June 26th through July 14th, the NASDAQ is up 31 out of the last 40 years. So do we get a period of time here where the NASDAQ does push through all-time highs? Time will tell. I mean, that's the wonderful thing about data and looking at it, supply and demand, is that we could tell, do the buyers have enough oomph in them to push it through? I don't know if I've ever used the term oomph on this podcast, but there's always a first for everything. And if Apple wants to participate, that's a great thing.
Yeah, Zaccardi had a good tweet on that. Yeah, like year 3 of a bull market, it's pretty choppy.
Yep. Yeah, year 3 out of 4. 1, 2, great. 3, choppy. 4, better. So it makes sense, the environment that we're in. But as we highlighted before, we're S&P's above a 200-day, above 5,800. These are good things. And I don't know that we could sit here and say the market's too high, because Zaccardi also highlighted that EQAL, which is the Russell 1000 equally weighted, 0% return since November of 2021. And then if we throw on there something like the Value Line Geometric Index, which is another way to measure what has the average stock done, 0% return since January of 2018. And small caps, IWM, who gets nothing but shade on this show until it starts getting an uptrend, but Russell 2000, 0% return since January 2021. So I don't know that we get to say that stocks are too high at this point.
Some stocks, but not stocks as a whole. Well, I mean, some stocks are high. It's hard to say anything's ever too high or too low.
Right. That's how momentum and trends work.
It's like saying something's due. Famous last
And
word.
I know, to marry the World War III narrative that's out there, we have pretty large retail equity outflows over the past few weeks. We have a put call ratio. I haven't necessarily heard anybody talk about this. That's elevated at about 0.98. So people are hedging pretty heavily here. And it makes sense, right? You go right into these prior highs from January and February to hedge that out. But we know that put buying is typically future fuel. If they get squeezed and have to be forced to close their position, it's really when market participants stop shorting this market. That's when you get a little bit more nervous. And here again, we've got pretty large hedging going on, pretty large bets going on that could cause a squeeze higher through the prior highs. We'll see. What about bonds? What about interest rates?
Interest rates staying up there. Sideways. Stock sideways for a couple of weeks. Interest rates sideways for, over a month. Consolidating near the highs. 30-year got up to 5%. We didn't really see a drastic sell-off. Not yet. Makes me feel like you want to err on the side of rates going higher, which we knew that, though. Based on the preceding trend. Well, they're hanging in there.
How about crypto?
Crypto also, if we talk about Bitcoin, hanging in there, really struggling with 107, 108. It's given it a couple good rally attempts, but cannot hold 108. Even tried again last week. Couldn't do it. So we're just stuck in a tight range. Well, tight for crypto. It's 100 to 110, if you want to call it that. 10% range is pretty low volatility for this asset.
Agreed. So I think it's appropriate at this time to highlight the supporter of this podcast, the Adaptive Select ETF, which is listed on the New York Stock Exchange under ticker ADPV, which helps investors access two of the most prevalent factors in markets, momentum and relative strength. Using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. What else would you like to highlight here, Ian?
An uneventful week. Rates flat. Yep. Stocks flat. Bitcoin flat. Gold flat. I think it's like we took the week off from volatility.
Yeah, that's fair.
Speaking of volatility, is VIX flat? Pretty flat.
Yep.
Which is good. We don't want volatility moving all over the place.
Agreed. So we covered quite a bit. I think it's a quick summary would be, if Apple starts to participate in this market, it's going to be really hard to pull it down. If you got things like JP Morgan and American Express breaking out versus the S&P, or broker dealers and capital markets breaking out versus the S&P, while interest rates are steady during a negative news cycle and high put call ratio, the ingredients are there as we head into a seasonally strong period here that we could push through all-time highs. But the beauty is we have the data in front of us for breaking back below 5,800 and a 200-day moving average on something like the S&P. That'll be information that buyers...
All bets are off.
All bets are off. We can adapt, Ian.
Man,
we don't have to...
That's nice. That's nice.
It is, right? We don't have to bury our head in the sand or dig our heels in. I can't think of any other metaphors. We just
can... then what? You're probably, if we go back below now, you're probably going to get a lot of talk about 2015, 2016 type behavior. Because we did that 2015 over, we rallied back across the 200-day, never quite made it to all-time highs, bumbled around there for a couple months, lower again, actually broke to new lows, recovered. So yeah, it could be. I'm not saying that happens. I'm not saying this 2 years of volatility. This is also be a pretty wide range. I mean, like a mega version of that. I don't even know if that's the right term.
Yeah,
that was what, just 12 and a 14% correction in there. So nothing terrible in regards to drawdowns. Obviously, we had a 20%, another 20% would. That'd be noisy, Dave. I can guarantee you that it would be noisy.
100%. And it would be, right, if price is doing that with the news cycle,
yeah,
be a lot of fear.
Of course, it makes total sense. Here comes World War III.
Yeah, exactly. So we'll see. We'll see where the market takes us. As always, we'll use price, the interaction of supply and demand, the manifestation of opinion, and final arbiter of value to determine whether to be involved or not. And right now we can be involved. Yes, there's going to be daily ups and downs, but it's not one day that makes a trend. It's about what the trend is overall. And as you highlighted at the beginning of the podcast, we have price above rising 200-day moving averages. Until then, it's the bull market is innocent until proven guilty. And if we drop below that, then guilty is charged and we adjust accordingly.
Can always adjust.
That's right.
I remember one time you owned 20-year treasury bonds for a couple hours.
That's right.
And that was the top.
Well, Ian, I appreciate you doing these with me. It was a great time. And to those listening, we hope you appreciate this. We hope you have a wonderful weekend, but we ask you to share this with your friends. Give us a high ranking on your platform of choice. That's a compliment to us, and we really appreciate it. Thanks, everyone.
Have a great weekend.